Good morning, traders. It is Wednesday, October 29, 2014, 8:02 a.m. Chicago time. Derivatives trading involves substantial risk of loss and is not suitable for all investors. My personal opinions, market data, and recommendations subject to change without notice. Past performance is not indicative of future results. Again, I'll remind you, for those who are just joining, required to read that risk disclaimer on every broadcast or video that I make, and that's why you have to hear it every morning. The news overnight, the general idea for today, as far as the overnight session is concerned, Asia carried forward the rally that we saw yesterday. Interesting trading yesterday. We'll go over that in a minute. But Europe just didn't do anything with it, just sat sideways. The Fed is poised to end its QE3 program today. However, dealers are noting that bond buying is a tool that the central bank has in its arsenal. So not sure what's going to happen and what if they're going to change the considerable time terminology or whatever. Last time it was very dovish. The release was very dovish. That number comes out at 1 o'clock. That announcement comes out at 1 o'clock today, 1 o'clock Central, 2 Eastern. Japan's September preliminary industrial production hits an 8-month high with month-on-month increase of 2.7% versus 2.2% expected. That's good news. U.S. Treasury Secretary Lew says U.S. economic indicators are very positive on trend and not a risk of major setback in the immediate future. He added that a strong dollar was good for the U.S. driven by core economic strength. I don't buy that. We all know that there's been a currency battle between central banks and sovereign nations for quite some time now. OPEC Secretary General El-Badri, for those who trade energies, says he did not see a big change in oil market fundamentals. OPEC was currently reviewing situation. Supply growth did not explain the decline in oil prices, but he did not have a price target. That was determined by the prices were determined by the market. He added that if oil stayed at $85 per barrel, a lot of oil would go out of the market. Russian ruble continued to hit fresh record lows against U.S. dollar and the euro. 10-year bond rose to test a 10% mark for the Russians' sanctions at work. The World Bank warned that China growth slowdown could be structural rather than cyclical, but there's more room for stimulus if growth slows sharply. Those are the key elements that I see from the overnight that have or could be driving our session. The S&P fair value is negative 6.2 points. This means that the S&P cash index is expected to trade 6.2 higher than the futures, or the futures are expected to trade 6.2 lower than the cash, in case you're trading SPY or are using the cash to do your homework. Looking ahead today, we have at 9:30 Central, we have DOE crude oil inventories expecting negative 700,000. U.S. gasoline inventories expecting negative 700,000. Distillate inventories negative 1.45 million. And U.S. refinery utilization at 0.5%. 1 o'clock, as I'd mentioned, the Fed QE3 pace should be announced. Also, the pace of Treasury purchases, MBS purchases, and the rate decision, the expected rate decision to stay stable at 0.25%. Beyond that, not seeing too much on deck for today. Bank of England's Haldane is expected to speak at 12:30. Bank of Canada Governor Poloz is testifying to the Senate committee at 3:15. As far as auctions, 10:30 we have a 2-year FRN auction for $15 billion, and at noon we have a 5-year note auction for $35 billion. And we have a bunch of earnings. So that's it for the setup for the day. Let's take a look at the technical picture. So let's start out with the big picture here. So we spent much of August and September, the entire month of September, and much of August in this balance zone here that made new highs. 2012.75. This is adjusted for the December contract. All of my charts are back adjusted for the current contract, so the prices move up or down for prior expired contracts depending on the premium of the current contract. It's called equalizing the chart in futures, so that you eliminate the gap for when we roll from one futures contract to the next. From the middle of August till the last day of September, we've been in this zone from 2012.75 down to 53.25, with the last low at 55.50 before the break. Many of you will recall 55.50 has been important recently. And then once we broke down, we had a nice breakdown to 18.25. We balanced, so we created a new micro composite in that area right there. Traded very wide. These days were very, very interesting. Very wide days, inside days. The market then fell and finally tested 1813, pushed through 1850, which is the most valuable price, or the most traded price going back to October 9th, 2013. We found buyers at 1813 and we started to push up. We have several gaps that have not been closed. The biggest of which is from the 17th of October. And then as we turned up, this became a microcomposite profile as well. Why? Because when the market trades around itself, or the market folds back on itself, the market price action folds on itself, I start to combine those days' profiles to see what the true picture is, especially when they're in balance. And that's what we did here. We gapped up again on the 21st, and then the next day we opened test higher and broke down, and then it started this this MC, this microcomposite profile. And as we continued to trade back and forth and chop, we extended this microcomposite all the way up to Monday. Yesterday was a breakout day. Why? Because it gapped open. The expectation yesterday, let's look at yesterday's trade on Orenco, just as if we were there. Of course, we don't have the profile and stuff, but yesterday's expectation, the primary expectation per Hypo 1 yesterday on the Trader Byte, the pre-market Trader Byte that I discussed, was for the market to gap open around the 63 area. And I was looking for a test of 65 early on, and responsive selling back to 60 quarter, 59, and potentially 57. And if it gets any deeper, it'll be 55.50. And then the expectation was for the market to turn around, find buyers in those zones. One of those zones turn around and start to drift up. The target above on the drift up would be 70, 71.75, 71.75, and 80 quarter, if you recall. And the way it traded was very interesting, because we had an open auction out of range, traded both sides, and then it broke. It tried to break lower, and then it finally broke higher, and it just sat sideways. It looked like this was ready to rip up and take us to 71.75, and it just came back, and it was a very, very choppy trade relative to the other indices. By comparison, if you look at the NASDAQ, one second. If you look at the NASDAQ, you have a tight open and then immediately we get the buyers coming in and holding steady at higher prices, holding steady at higher prices, and continuing to push all the way through. The S&P was on its own yesterday; it just could not get anywhere. The same with the Dow, and this is what it traded like. It was pretty awful. Finally, once it's worn everybody out. Finally, we get the break. So here we get a break through the IB high, a retest of the IB high, and off to the races we go. 71.75 gets hit. 71.75 gets hit here, and it's right in the last hour. It continues to push all the way up to and through the 80 quarter target by 2 ticks. And it closes right at 80 even. Pretty amazing given the type of day it was. I did not expect yesterday to be as tight as it was in the morning. I expect today to be that way since the FOMC is coming out today. I did not think that it would be as sluggish as it was. When we look at the relative volume of how it traded, I'm going to narrow the session down to the first hour. And if you look at the relative volume for the first hour trading for the last few sessions, the yellow bar here gives you the 20-day median. The 20-day median is the yellow, and the green or red is the actual. And if you look at yesterday, I'd announced on Twitter that yesterday was the lowest volume first hour since the 6th, and then it goes all the way back to the 17th. 17th, 18th, and 22nd. Yesterday was not that much better, 319 versus the median of 492. So you could see volume really exceeded during that drop. You can see the bars going higher than the yellow lines, giving us the median, and then the median catches up. It's a 20-day median, and it catches up based on the volume generated here. And now we're well below it. It's just it makes for a much more sluggish trade, really. So overall, yesterday was a bit of a surprise to me that it would, given the morning action, which is where I expected most of the volatility to be. It was a surprise to me that it would break and hold. There's this thing that happens at every FOMC. There's a lengthy study that's been posted several times on Twitter called the FOMC drift. And in general, the market tends to drift up on the FOMC release, and then it just gets flat after that. So maybe this is part of the drift here. It just puts into question what's likely to happen today. I know that today I'm just basically sitting on my hands until the FOMC release. I was in the middle of doing a study just now on FOMC ranges going back a couple of years, and I did not finish that. So look on Twitter, and if you're at Stage 5 Trading, look in the chat room for the results of that study, just to give us an idea of how the ranges may have compressed and how the market has reacted the last few times to the FOMC release. But so far, when I look at the overnight session, we had a small gap down on earnings, and it's drifted back up, and it's really done nothing. The market's completely balanced overnight, pushed to 81.50, but it really a very, very boxy profile and pretty low volume. So hard for me to figure out what or to handicap or provide a probability for which side is likely to play. So for me, Hypo 1 today is likely to be just keep your hands off. I'm going to, this is more of a scalping start for the day. We are at a key CLVN here. We are in the balance zone. If you look at this balance zone and put your cursor across the 80 quarter, you'll see why there's a CLVN there. It was a double bottom back here in August and early September, and it was retested again late September. I'm not sure what to make of this right now. So the best plan, since I don't have a clear probability to trade against, my plan is to just sit tight and wait to see what happens. Given the configuration of how this closed, there are a lot of single prints here. So you can see yesterday we left several single prints behind, and there's definitely the market really started running on a price discovery basis, has gone vertical, and that creates a weaker structure below. So for me, I'm just going to sit out and wait and see which side is likely to dominate early on. I expect it to get really quiet until 1 o'clock Central when the FOMC comes out, and I expect the bigger guns to step in. Lately, the FOMC has pushed about 6 to 8 points, but I'll finish that study and post the results. This is a perfect opportunity for you to catch the video that I posted on my website, futurestrader71.com, from the Big Mike Trading regarding scalping. You might want to just, since it's probably going to be a pretty boring day, you might want to watch that webinar where I just demonstrate some live scalps and the importance of risk control while trading. Maybe that bores you, maybe it doesn't, but I know that this morning's action has a 50-50 chance. There's just not, I don't see an edge up here on the open. So I'm going to wait to see who's in control and see if responsive sellers come back in and push this back down to 71.75, or if it's going to linger here and continue the FOMC drift into the announcement. I don't have anything more specific than that. Again, I want to remind you that I will not be here starting November 7th through the 21st. I'll be in India speaking on an invitation by the Eurex exchange. I'll be gone for 2 weeks. I'll be doing trader bites wherever I can. There's a 10.5-hour difference, Chicago to Mumbai and New Delhi. But in case you notice that I'm silent, that is why. I wish you the best of luck today. Please save your bullets for the FOMC and the volatility that comes with that, and just don't violate your risk. It's just the worst thing you can do as a trader is just continuously violate your risk. You need your ability to confide, to be confident in yourself, to take yourself out in order to take the risk of trading. It's a tremendous risk, especially in a leveraged product, just as futures are. It's important to trust that when things don't go well, that you will take your stops and you will take yourself out. It's a key element to what professionals do. Good luck today. And if you have questions, again, futurestrader71.com/contact, and I'll do my best to help you. Take care.